The post-election rally assumed Trump's policies would be business-friendly. But as tariffs reshape global trade and consumer spending weakens, a different picture is emerging. With government debt projected to reach 160% of GDP and interest rates expected to bottom out at around 4% versus 2%, today we're asking if the market has misjudged the economic impact of the new administration's agenda. We're going to break that all down for you and a lot more right now on UBS Trending. Hello, everyone, and thank you for joining me. I'm Anthony Pastore, and this is UBS Trending. My guest in the studio is the chief economist at Apollo, Torsten Slok. Torsten, nice to have you join me. Good to see you.
Thanks for having me.
That opening really was very sobering in a lot of ways, and I think that's kind of the direction of the conversation that we're going to have today, which is that we're all right now seeing this period of uncertainty, this period of volatility, and a Fed that is putting words like transitory back in its statements, which we haven't seen for some time now. I think, in going back to the intro, the markets did rally because of Trump's pro-business stance, what he campaigned on in 2016, but that doesn't seem to be what's happening right now with tariffs. How are investors interpreting the new administration's policies? Because that really is the question that we're wondering.
Yeah, so during Trump's first term, obviously, he started out with doing three things. He lowered taxes. Taxes for corporates went down from 35 to 21%. Taxes for households went down from 39.6 to 37%. So household and corporate taxes came down. He also did deregulation. He also did more energy production. All that was a very important reason why the stock market went up, because this was all that could be described as business friendly. This time around, he started somewhere else. He started with tariffs and he started with DOGE. Tariffs are not necessarily business unfriendly, but it requires some pretty dramatic changes in the US economy where he wants to grow the manufacturing sector. So that requires an adjustment where some sectors need to be smaller and other sectors need to be bigger. That comes with some significant downsides to the economic outlook as that adjustment plays out. DOGE likewise comes with the risk that if you fire a lot of government workers, and remember for every government worker there are 2 contractors, that puts upward pressure, of course, on the unemployment rate. So if you begin to see the unemployment rate moving higher, as many as 300,000 government workers potentially losing their jobs and 600,000 contractors therefore losing their jobs, it could be as much as 1 million people potentially losing their jobs. That's also something that, not that that's not business unfriendly, but it's something that at least for markets putting upward pressure on the unemployment rate has created all the uncertainty that you're talking about.
Right, and of course that's something that Powell and the rest of the FOMC are certainly keeping in mind. They understand how many people are losing their jobs now and how that might impact unemployment as we look down the next couple of months. But, back to what we were saying. So there is a lot of noise around tariffs, and it's the put it out there, put it on hold, give us later dates when these things might go into effect, and we don't know from day to day if we're going to get different numbers, other countries that might be impacted. Talk about the tariffs that we know today and how that the market has responded and how you expect it to go.
Yeah, this is absolutely critical for markets at the moment, because what the tariffs have done is that they have increased uncertainty for consumers. And consumers have responded in the University of Michigan survey, in the Conference Board survey, by saying, we think that business conditions will get worse over the next 6 months. Consumers have responded by saying, we think inflation will be higher over the next 6 months. Consumers are also responding at the moment by saying, we are planning to go less on vacation. So maybe the risk on the consumer side is that with elevated uncertainty, we have the risk that consumers might begin to say, maybe I shouldn't be buying that car, maybe I shouldn't be buying that washer and dryer, maybe I shouldn't be buying a new iPhone. And the same thing is also taking place for companies. Companies are also beginning to pull back. You've seen CapEx plans in this regional Fed district surveys show that companies are beginning to cut back on CapEx planning. So combined with consumer confidence being lower, corporate confidence being lower, it is a major worry that sentiment has eroded so much.
Does that consumer sentiment erosion change the belief that the Fed is going to possibly cut 50 basis points this year? That's the expectation that we still have here. That's our house view at UBS, and I think that's the general consensus. But after hearing the word transitory in the statement from the recent Fed I wonder if they're rethinking what they might need to do next.
Well, because exactly the important point here is that the Fed has a dual mandate. Namely, on the one hand, they need inflation at 2%, and on the other hand, they need full employment. If now we are going away from full employment, and if the unemployment rate goes up, partly because people get fired in the government sector, but also the employment rate could go up because there's a risk that the trade war may begin to weigh on the economy, then you suddenly have this very unusual situation of stagflation, where the Fed is caught where if inflation is going up, the Fed should be hiking, but if growth is slowing down, the Fed should be cutting. So which one is it? How would they put the weight on this? And Powell has already said, as you just pointed out, that we are probably going to cut rates twice this year, mainly saying we might not put more weight now on growth slowing down rather than putting weight on inflation being high. And that raises these very important discussions around, are we backing away from the Paul Volcker attitude that Fed used to have on what inflation was doing? And is there a risk that there might be more focus on growth slowing down and less focus on inflation moving up?
Right, and if the Fed doesn't cut the rates this year, you could have impacts to consumer spending, obviously to borrowing as rates stay high. It could really have a negative impact on the economic outlook for the rest of the year into 2026. So, I mean, there's a lot. Obviously, like you said, the dual mandate really it's a balancing of the scales, I think, at this point for Powell.
Because if rates are higher for longer, which is what we should expect, no one is talking about that there is with certainty coming a recession. What we are waiting for now is that the first leg of this was that sentiment deteriorated for consumers and for corporates. Now, the next question is how much of that will spill over to the hard data? Will we see non-farm payrolls when it comes out for the month of March on April the 4th? Will we see the unemployment rate go up? Will we see job growth slow down? And most importantly, what is the impact of tariffs on earnings? There is a risk now that over the next several quarters, we will begin to see the negative consequences of tariffs play out through weaker earnings in the S&P 500. So it's those two things combined, namely we have weakness in the soft data because consumers and companies are getting more worried. And the next leg of this is the uncertainty around how much is this going to negatively impact the earnings outlook for the S&P 500.
Yeah, it's a very critical quarter that's coming up for us. And obviously, as you said, Torsten, looking at those jobs numbers for March that come out in the beginning of April is going to be a real tell. So with everything that's been going on, maybe you can shed some light on where you and Apollo, by the way, Apollo's great partners to UBS, where you're sort of finding the opportunity in a lot of this uncertainty and the volatility that we've been experiencing since the inauguration.
Well, I think there are two investment implications of our conversation. Number one is that nobody expects, at least very few people expect a recession, because the size of the shock, meaning the 25% on Mexico and Canada and 20% on China, while it sounds like significant numbers, it's not something that's big enough in our simulations, as several of the charts that you have shown here also suggest that we are not going to see a recession on the back of that. So with that, with rates higher for longer, the number one conclusion is cutting coupons in fixed income and in particular in private credit continues to be a great strategy because the yield levels will still be elevated. And when you're up in quality, first lien, senior secured, large cap companies, the best protection you can get, stay away from lower rated credits because they are vulnerable. If there is a recession probability, they are vulnerable when rates are higher for longer. So for that reason, private credit, high quality, investment grade, high quality, high yield will continue to do well. The second conclusion is that if the volatility is stomach churning in the S&P 500, why not take some money and put it into private credit or fixed income and sleep better at night so that I don't have to live through this, oh gee, will Nvidia earnings go up or down? Oh gee, what's going on with tariffs on companies that are trading with Canada and Mexico? All that is very interesting. I follow that very, very closely like you 24 hours a day. Yeah. But I do think that it is a good time and a good opportunity to say, why not cut some coupons and every month or every quarter get a steady cash flow, especially in a rates higher for longer environment, instead of having these sleepless nights where the stock market or asset classes go up and down because of this significant volatility we're having at the moment. So in short, benefit from the level of yields being higher, make sure you're up in quality, and second, make sure you stay away from the volatility that comes from some of these very eye-popping situations we have at the moment with the stock market going first down and then up.
Absolutely. My heart always skips a beat when I watch the S&P, but I'm like, no, I'm a long-term investor. I've got a really good advisor who knows what I'm into, and that transactional type of trading, it's just not for me. And I know it is for some, but
always important to remember to be diversified.
That's
Page 1 of your
exactly
finance textbook tells you, I have to be diversified. diversified, and therefore don't put all your money into the S&E basket. We all love the up and down and adrenaline rush you get on the back of that, but in private credit, you can get some very steady, stable returns, especially if you're up in quality.
That's right. I could drive a Ferrari every day, but I'd rather just stick with my Honda, if you know what I mean. Nice and steady, it'll last forever. Anyway, Torsten, thank you very much. We really appreciate you coming by.
Thank you.
Great, good to see you. And by the way, that matches very well with our CIO view of long-term investing and, of course, having a diversified portfolio and working with a financial advisor. So for more information on all of that and more on the conversation that we had here with Torsten, you can check out our website at ubs.com/views, and you can follow UBS on social media. We're on LinkedIn, Facebook, and Instagram. We've got a dedicated channel there for the studio at UBS Trending. And again, talk to a financial advisor if you'd like to continue this discussion. Until next time, I'm Anthony Pastore. Have a great rest of your day, and remember to keep your eyes on what's trending. We'll see you soon, everybody.